Passed in dramatic fashion by the House and Senate on January 1st and signed into law by the President on January 2nd, the American Taxpayer Relief Act prevented the country from going over the fiscal cliff by extending a host of tax provisions and temporarily postponing major automatic spending cuts that were scheduled to take effect in 2013. The new legislation provides certainty by making many of the expiring tax provisions permanent. It also increases the top income and estate tax rates. Here are some brief highlights of the new law. The new legislation makes permanent the 6 federal income tax rates that were in effect for 2012, but creates a new top rate of 39.6% beginning this year for individuals with taxable incomes exceeding $400,000 and married couples filing joint returns with taxable incomes exceeding $450,000. The legislation makes the existing rates that generally apply to long-term capital gains and qualifying dividends permanent as well. As a result, taxpayers in the lowest 2 tax brackets will generally pay no tax on long-term capital gains or qualified dividends, and those in the next 4 brackets will generally continue to pay tax at a maximum rate of 15%. However, starting this year, a new 20% maximum rate will generally apply to those in the 39.6% tax bracket. The new legislation also permanently extends alternative minimum tax relief in the form of increased AMT exemption amounts. The increased exemption amounts apply retroactively to 2012 and will be indexed for inflation in future years. Also permanently extended are provisions that allow personal tax credits to offset AMT liability. Additionally, the top federal estate tax rate is permanently increased from 35% in 2012 to 40% beginning in 2013. The $5 million estate and gift tax exclusion amount indexed for inflation that applied in 2012 is retained as well. The legislation also makes permanent the portability provisions in effect for 2011 and 2012 that allow the executor of a deceased individual's estate to transfer any unused exclusion amount to the individual's surviving spouse. The Act phases out personal and dependency exemptions for high-income individuals starting in 2013. These individuals may also be subject to a limitation on the amount of itemized deductions they are able to claim. Finally, the legislation extends a host of other tax provisions that had expired. Some are extended permanently, others temporarily. Regardless of how the legislation affects your individual situation, the Act eliminates a lot of uncertainty and helps create a more stable planning environment. Because many of the issues addressed by the American Taxpayer Relief Act apply retroactively to 2012, you'll want to take some time now to consider whether you're affected.